What are the best dividend ETFs to invest in for 2025? If you are new to investing, or even if you have been in the market for a while, dividend ETFs can be one of the smartest ways to grow your wealth, generate passive income, and protect your money from inflation. With so many options out there, it can feel overwhelming. That is why in this video, we are going to simplify everything. First, let's cover the basics. An ETF, or exchange-traded fund, is like a basket of investments. Instead of buying a single company, you buy small pieces of many companies at once. This spreads out your risk and makes investing easier. A dividend ETF is just an ETF that holds companies known for paying dividends. Dividends are cash rewards that companies give to their shareholders, usually every quarter, just for owning their stock. By investing in a dividend ETF, you not only hope the price goes up, but you also receive steady cash payments. This is one of the main reasons why dividend ETFs are so attractive, especially for beginners. Now, why are dividend ETFs especially attractive in 2025? The markets have been uncertain. Interest rates, inflation, and global events all affect how stocks perform. Dividend-paying companies are usually more stable and reliable. Even when markets dip, dividends continue to be paid. That means steady passive income for you. If you reinvest those dividends, you can compound your returns over time. Compounding simply means your dividends buy more shares, and those shares then produce even more dividends. Over years, this creates massive growth. Dividend ETFs also make investing simple and accessible. You do not need thousands of dollars to start. Many platforms allow you to invest with as little as $1 or buy fractional shares. Before we look at the best dividend ETFs for 2025, it is important to understand what to look for. The first thing is dividend yield. This is the percentage of the ETF's price that it pays out annually. For example, if an ETF is $100 per share and pays $3 in dividends each year, the yield is 3%. A higher yield sounds great, but be careful. Sometimes a very high yield means the company may not be able to sustain those payments. The second thing is the expense ratio. This is the annual fee the fund charges. A good dividend ETF usually has an expense ratio below 0.2%. The third thing is diversification. You want an ETF that holds companies across different industries, so your investment is not tied to the success of just one sector. The fourth thing is payout frequency. Some ETFs pay quarterly, others monthly. Monthly payments are great if you want regular cash flow, but both work fine for long-term investors. Finally, look at the performance history. While past results do not guarantee the future, a consistent history of paying dividends shows reliability. Now let's talk about the best dividend ETFs to consider in 2025. All of this information is accurate as of the time of recording, which is September 20th, 2025. Keep in mind that yields and prices change over time, so always check the latest data before investing. The first ETF is the Vanguard High Dividend Yield ETF, ticker symbol VYM. Its dividend yield is about 2.48%, with an expense ratio of just 0.06%. VYM focuses on large U.S. companies with above-average dividend yields. Inside it, you will find companies like Johnson & Johnson, Procter & Gamble, and J.P. Morgan Chase. These are strong, stable businesses that have paid dividends for decades. VYM is low-cost, highly diversified, and a great core holding for beginners. The second ETF is the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. Its yield is around 3.5%, and its expense ratio is also a very low 0.06%. SCHD is a favorite among dividend investors because it combines income with growth potential. The companies inside SCHD are chosen based on their financial strength and consistent dividend history. Over the past decade, SCHD has often outperformed similar funds. For beginners who want both dividend income and strong long-term growth, SCHD is one of the best choices. The third ETF is the iShares Select Dividend ETF, ticker symbol DVY. Its yield is roughly between 3.8 and 4%. But the expense ratio is higher at 0.38%. DVY focuses heavily on utilities and energy companies, which are known for high dividend payouts. That makes it attractive for income, but it does mean the ETF is more concentrated in certain industries. For beginners, it can be a solid option if you want higher income, but you should balance it with other ETFs. The fourth ETF is the iShares Core High Dividend ETF, ticker symbol HDV. Its yield is currently about 3.2 to 3.3%, with an expense ratio of 0.08%. HDV focuses on financially strong, high-quality companies across sectors like healthcare, energy, and consumer staples. It is well diversified and offers reliable dividends, making it another strong pick for long-term investors who value stability. The fifth ETF is the SPDRS and P Dividend ETF, ticker symbol SDY. Its yield is about 2.7 to 3%, with an expense ratio of 0.35%. What makes SDY unique is its strict rule. It only includes companies that have raised their dividends for at least 20 consecutive years. This means you are investing in businesses with a proven commitment to shareholders. If consistency is what you are after, SDY is an excellent option. The sixth ETF is the Global X Super Dividend ETF, ticker symbol SDIV. This one is different because its yield is extremely high, around 10 to 11%. The expense ratio is 0.58%, which is higher than most. SDIV focuses on high-yield companies from around the world. While that sounds appealing, remember that high yield often means higher risk. Many of the companies in SDIV are smaller and less stable. That is why SDIV is not recommended as a core holding for beginners. Some investors use it for a small portion of their portfolio to boost income, but it comes with volatility. The seventh ETF is the JP Morgan Equity Premium Income ETF, ticker symbol JEPI. Its distribution yield is around 8 to 9%, and its expense ratio is 0.35%. JEPI is unique because it uses a covered call strategy. In simple terms, it invests in large U.S. companies and also sells options to generate extra income. The result is very high monthly income, but the trade-off is less long-term growth compared to funds like SCHD or VYM. JEPI has become extremely popular among investors who want cash flow every month. The eighth ETF worth mentioning is the Vanguard International High Dividend Yield ETF, ticker symbol VYMI. Its yield is around 4%, with an expense ratio of 0.17%. VYMI focuses on companies outside the United States, giving you global exposure. This is important because you do not want your entire portfolio tied to just one country. With VYMI, you get dividends from companies in Europe, Asia, and emerging markets. Now that we have looked at the top ETFs, how do you put them together in a portfolio? Here is a simple beginner-friendly example. You could put 50% of your money into SCHD for balanced growth and dividends. Then add 30% into VYM for broad U.S. stability. Next, add 10% into JEPI if you want monthly income. Finally, add 10% into VYMI for international diversification. With just 4 ETFs, you get exposure to hundreds of companies, steady dividend income, and a mix of growth and stability. Before you start investing, let's quickly go over some common mistakes beginners make with dividend ETFs. The first mistake is chasing the highest yield. Remember, if something looks too good to be true, it probably is. A super high yield often means the company or fund is taking on a lot of risk. The second mistake is ignoring expense ratios. Fees may seem small, but they add up massively over time. The third mistake is not reinvesting dividends. If you don't need the money now, reinvesting allows your wealth to grow much faster through compounding. The fourth mistake is putting all your money into just one ETF. Diversification is key to long-term success. The fifth mistake is short-term thinking. Dividend ETFs are not a get-rich-quick scheme. They are designed for long-term, steady growth. So what is the bottom line? Dividend ETFs are one of the best investment tools for beginners in 2025. They are simple, diversified, and provide consistent passive income. The top choices right now are SCHD, VYM, HDV, DVY, SDY, JEPI, and VYMI. Each one has its strengths, and the right mix depends on your personal goals. Do you want steady growth? Go with SCHD and VYM. Do you want high monthly income? JEPI might be right for you. Do you want global diversification? Add VYMI. Remember, all of the information in this video is accurate as of September 20th, 2025. Yields and prices change, so always double-check before investing. More importantly, remember that investing is not about timing the market. It is about time in the market. The earlier you start, the more powerful compounding becomes. Whether you are starting with $100 or $10,000, Dividend ETFs can help you build wealth and create financial freedom. If you found this helpful, make sure to hit the like button, subscribe for more beginner-friendly finance content, and drop a comment below telling me which dividend ETF you are most interested in for 2025. Thanks for watching, and I will see you in the next video.